All right, welcome back. It's the Avid Investor Podcast with me, your host, Josh Adamek. And here we are, episode 53. And today I'm going to talk about market predictions, market cycles, what I see, and what my opinions are on predictions and cycles. So here goes. So first off, let me start by saying I am asked constantly, at least once a week, if not more. Hey, what are you seeing in the market? What's your predictions? When's the bottom going to fall out? What's the next hot area? That's something I haven't had for a while, but I used to get that asked of me constantly. Uh, what's the next hot area? What's the next hot area? Why were people asking me that? Why? Because I was very very heavily invested in Lawrenceville in 2012 up through 2000, call it 15, 16, something like that. I think I was out by 17. So I started I started in that area. My first house that I bought in Lawrenceville, I'll never forget this, on Plummer Street. I bought it, uh, closed on it, did a full remodel, listed it for sale. And at the time, I think this was 2012. At the time, listed it for 175,000. And once it went active, or once we put it out there, I'm like, man, who the heck's going to pay 175 to 175 G's to live in Lawrenceville? And boom, sure enough, it sold. It sold like, next day or something. There was no multiple offers or anything like we see in the market now, but it sold quick, full price, no issues, closed out. Now, fast forward, that same house, a little more than a decade later, I haven't checked for a while, but last time I looked, it was probably in the 550, 600 range, probably more now. But anyways, so people saw me investing in Lawrenceville and doing a lot, very 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 active down there, and they thought I was like some sort of genius on market cycles, market predictions. In reality, it's impossible to time the market. So that's three things that I wanted to talk about on this episode today. And number one, it's impossible to time the market. I mean, you can make assumptions, and there is some data at your disposal that can help you make those assumptions, but in reality it's impossible to time the market, and it's impossible to predict the market. You can make your assumptions based on the information that you have available, but there are so many circumstances that are outside of anyone's control that it's impossible to time the market. At the end of the day, it's nothing more than luck. So, fortunately for me and my team, we got involved heavily in Lawrenceville, like I said, in 2012. Started doing a lot of projects down there, a lot of remodels, crazy, burnouts, full gut remodels on 120-year-old houses, doing additions, adding rooftop decks, opening up roofs to make, third floor master suites. Lots of heavy lifting, heavy engineering, heavy construction, remodeling, reworking those old homes. You had a rooftop deck, you got to carry the load all the way down to the basement. And the engineer has to draw that up. The contractors have to make it happen, and it becomes a lot of work. But anyways, we were very heavy there. Then during that time, I had the opportunity to buy some land, buy some lots down there, and before I knew it, I became a builder. We were doing infill new construction. Built a house. I think it was on 44th Street. My first new construction, new build there. Had some challenges like anyone else. Maybe more than most, or more than average. But had some challenges there. Completed my first build. We sold it. We made some money. I moved over a street over, bought 4 lots. We were planning on selling the homes at X. I think we were planning on selling them at 550 each. Started the project. Hit all kinds of unknowns, because I went from building one house to 4 homes. Hit all kind of unknowns, that one, I wasn't aware of, and two, just stuff that we found throughout the process, or learn throughout the process. Um, and at the end of the day, blew our construction budget out of the water, by a couple hundred grand. But fortunately, again, at the end of the day, those homes sold for the low to mid sixes as opposed to the mid fives. So there was fortunately, the market was going up and rising as I was down there, learning to become a builder. And the important part is, I mean, we built and delivered quality homes. We renovated and delivered quality homes to a lot of homeowners, families, residents. And over the last couple years, over the last decade or so, every once in a while, I'll see one of the homes that we renovated, we sold, and then it'll go back on the market for 100 grand more, a couple hundred grand more, a lot more than we sold it for. And in one hand, I'm like, man, if we were working the model, the equity model, the long term play that we have now, back when I was in buying everything in Lawrenceville, if we would have held on to those and had the model that we had now, I mean, our 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 spreads, it'd be crazy. We'd be in a totally different ball game. But then on the flip side, I see these folks that paid a very fair price for the home, fair for the buyer, fair for the seller. At the time, and then fast forward a couple of years later, 3, 4, or 5, 10 years later, they're selling those homes and they're making a boatload of money. So that's pretty cool. I've seen that time and time again where it's even out areas outside of Lawrenceville. Never forget this one. We remodeled a house in Brighton Heights, sold it to a young couple. Very young couple. I mean, I think early 20s. It was their first home. They bought it. I think they paid, I don't know, 150,000 for it or something like that. And then I see like a year or two later, it went up for sale. They sold it, and they sold it for like 225, 250, something like that. And I'm thinking, man, that is really cool. That young couple, they were, probably not even 25 years old at the time. They probably just bagged, 60, 75 grand, 80 grand, on their own home. Like they knew nothing about real estate. That was the first time they bought a house and they knew nothing about it. And they did very well. So, but going back to my main point of this, episode is market predictions, market cycles. Again, I went off on a tangent there, but I wanted to talk about why people are constantly asking me what's the next hot area. So first off, my opinion on market predictions when it comes to the next hot area, your guess is as good as mine, right? So I'm not super in tune with what's happening over in the East End as much as I was, when I was heavy in Lawrenceville, 2012, 2012 to 2017 ish, call it. We're in different areas targeting different properties, so I'm not as in tune as what's going on there. But interestingly enough, everybody always had said that Children's Hospital, Children's Hospital, Children's Hospital. Oh, it's bringing all this growth to Lawrenceville and the community. And while that may be true, what I can tell you is when I was very, very active in Lawrenceville for whatever that was, 5, 6 years, and I sold dozens and dozens and dozens of homes that we fully remodeled and sold, that we built and sold. We sold dozens and dozens and dozens of projects down there, all within, most of which were within walking distance of Children's Hospital. What I can tell you is that never once did I sell a home that I'm aware of to an employee of Children's Hospital. So everybody, that was the big hype. Children's is changing Lawrenceville. Children's is doing this. And while that may be true, I didn't personally. That may have some legs under it, some truth behind it. But I could tell you that I didn't experience any of that. I didn't see any of that firsthand, and I was very, very active. So So while that may be a draw, but I can tell you that out of a lot of those homes that I sold to a lot of UPMC employees, but none of which worked at Children's Hospital. Um, so I thought that was kind of interesting. It's like, that was supposedly the big draw. My opinion is that other factors, many other factors, played into the growth and the proper growth and stability of Lawrenceville in that area. There was a lot of demand there, a lot of things happening, and the two CDCs, Community Development Corporations, Lawrenceville Corp, Lawrenceville United. My opinion is that they did some tremendous things. For that area with closely monitoring the business district, Butler Street. So when that area's blowing up and everybody's going to Lawrenceville, they were they were battling a lot of businesses on that wanted to go into Butler Street, primarily trying to keep a lot of the bars out and not have Lawrenceville become the next South Side. So that was the big battle. And my opinion is that even now, almost a decade later, because they fought that fight and really closely monitored Butler Street and the business district. I mean, that's a big driving factor of what's happening in Lawrenceville. So again, I'm asked not as often as I used to be, but from time to time, what's the next hot area? The next hot area. I don't know. I don't know. Lay out a map on your desk on your table, or hang a map on the wall and throw a dart at it. Like that that'll give you about as good of an answer as I could give you. Are there things happening that in certain areas that you may want to be aware of? Yes, there's certain growth area. There's certain things happening, but at the end of the day, is there anything that is a slam dunk? Like, dude, you got to go buy 50 houses in this neighborhood? No, absolutely not. Let's take a step back. Pre Lawrenceville, let's take a step back to and take a look at the Homestead area. Um, I don't remember when it was, but it had to be uh 15, 20 years ago, when the waterfront went in. I don't remember the time, and maybe I should have looked it up before this episode, but let's just call it 15 years ago. No, it's been longer than that. Let's call it 20 years ago when the waterfront went in. That was going to be the turning point for Homestead, right? That was the big talk. Oh, this, whatever it was, couple $100 million waterfront development is going to change this entire neighborhood. Did that happen? No. Why? I, Again, I don't know. I wasn't heavily involved there, but I can tell you, like the waterfront, it's kind of there's the train tracks that kind of cut it off from the rest of the community there. It's not easily accessible from Homestead. So the waterfront, like if you were looking at an area, let's say for example, the next talk of the riverfront development is Esplanade, which is an amazing project by the Pyatt family over in the north side. Um, and they're going to completely revamp the riverfront there, do some really cool stuff. I'm not totally in tune with the final plan, but it started off as like a $700 million development, $800 million development. I think since then they've scaled it back a bit. I don't know what the final is, but call it $500 million, a $500 million. They're the Pyatt family is who we must credit for doing amazing things for the city of Pittsburgh in general. With their many developments and constant reinvestment in the city of Pittsburgh. Shout out to Jack Pyatt for being the pioneer in the city of Pittsburgh with Pyatt Place. It had to be, again, I don't know when that would have been, 10, 15 years ago, maybe longer. And then since then, uh, Lucas Pyatt and the Pyatt family has, taken the reins and continued to do amazing things in the city of Pittsburgh, and will continue to do amazing things for the city of Pittsburgh with the Esplanade project. So let's take a look at that, for example, because the waterfront didn't really do much for, the neighboring community, Homestead. So Esplanade, for example, $500 million riverfront project that's slated. It's going to be amazing. Am I going down to the north side to Manchester, that part of the north side, North Shore, and buying up as much residential real estate as I can? No, I'm not. You could if you wanted to. Prices are already up pretty good, in those areas. But my opinion there is, the development is going to be absolutely amazing. Uh, and it's going to do really cool things. It's going to be a great addition to the city of Pittsburgh. But when it comes to, the surrounding community and piggybacking off of that, I think, the residential is, Manchester, Allegheny West over there. That's still a little ways away from Esplanade. Could there be little bit of an uptick there, and a little bit more demand for people that want to be near the new development that, you know, might be in a little bit lower price point, or, want a little bit more space or something like that, a little bigger home as opposed to, waterfront condo. Yeah, absolutely. There might be some opportunity, but again, like I'm not going, putting all my eggs in one basket and going down there and buying, 50 or 100 houses, or trying to. That's just not my thing. So, could you do it? Could you go down there and tie up some properties in Allegheny West, Manchester, and piggyback off that, 5 years from now, 10 years from now? Yeah, sure you could. Maybe it might work. Um, but that's not what I do. I don't try to predict market cycles. I don't try to time markets. And or when it comes to, that's the other thing that I wanted to talk about. So we talked about predictions. When it comes to uh, market cycles, and understanding market cycles, so this is very important, because that kind of ties in with predictions. So everybody wants to know the next hot area, the next this, the next that. The other question that I get a lot is, so when's the bottom going to fall out? When are we going to go into a recession? When are we going to, when are foreclosures going to be falling off, hanging from the trees again? And what's interesting with that is there are quite a few people, mainly, some real estate agents, some investors, that quote unquote investors, and agents that have just come into the business within the last 3 or 4 years. Somebody that's new to the business with, less than a decade's experience. That doesn't truly understand market cycles and how markets work and what a normal market is. There's a lot of people that think we're in a recession right now because interest rates aren't 2%, interest rates aren't 3%. You're not listing a house and, it's selling first day on the market with 20 offers going 100,000 over ask. That, and in reality, like, that market is just a crazy market, insane. And the market that we're in, more reasonable, days on market with homes, interest rates that are, 6.5 to 7%, 7.5%. Guess what, folks? This is a normal market. We're in a normal market. This is normal. In all reality, like, we might even still be in an up market, in my opinion. No, we are still in a seller's market. It's definitely a seller's market. You know, prices, and I don't follow this, to the T day to day, but, I see stuff that's, you get a house listed at the right price. Uh, there's an inventory, there's a supply demand. issue. There's still more buyers than sellers right now. And if a home is listed at a decent price, is a reasonable price, not a post-COVID price, but at a reasonable price. It's listed right. They're still selling quick, right? Regardless of interest rates. But it is interesting because I did was talking to a friend of mine at a happy hour thing last week, and he's got a big home in a really exclusive neighborhood, and he says to me, he says, yeah, he says, I'd like to sell my home. I'm thinking about selling my home, or I'd like to sell my home, but where am I going to go? And, rates are up right now. And I told him, I said, look, man, I said, there's a supply demand issue. I said, there's nothing, in there, there's not much inventory in the luxury market right now. And, his comment back to me was like, yeah, but where am I going to go? Like, I got a 2% more interest rate on my mortgage. So that's where a lot of people are at right now. Many homeowners took full advantage of those 2 and 3% interest rates and refinanced, repositioned their leverage on their home and took advantage of it. And now it's like, what are they going to buy? Sure, they could sell their home, but what are they going to buy? So we have that inventory issue. But when it comes to market cycles, if you look historically, and I know I've talked about this before, but it's been quite some time. Markets go up, markets go down. It's like there's four different cycles to the market. So we uh, we're in a bit of a correction period right now. We're in the high market. Um, and then we're in a bit of a correction period right now, where we're not in the craziness, but we're nowhere near the bottom. We're nowhere near a bottom, a recession, anything like that. We're just in that middle, in that normal market. And we're not in a recession. We're in a correction period. It's like we're being corrected from the craziness in the market. And And what many people don't understand, especially those that have been in the business or come into the business in the last 3 to 5 years, is you know you've been on this rise, right? You've been on this rise where you're buying houses, you're fixing them up, you're flipping them, boom, they're selling, boom, they're selling, boom, they're selling, and then there's a little bit of a correction period where prices have to be adjusted a little bit more to be competitive, to be in line with interest rates. You're not hitting the 50 or 100K over asking, that we were coming out of COVID. We're in this correction period, and it's very, very um, interesting and kind of sad to see that how many people are so drastically affected in a negative way, that got caught holding the bag here, that are like borderline bankrupt, out of business, because all of their business, whether it was an investor or an agent that was new to the business, that didn't understand market cycles, that is now caught holding the bag, that went out and made all these commitments thinking the market's going to be good forever. And now there's a little bit of a correction period and we're in a normal market, and going from crazy to normal was enough to like put these people over the edge. So it's very important to understand market cycles, and understand, well, while you can't predict the market, I can't predict that whatever the bottom is going to fall out next week, next month, next year. I can't predict any of that. For example, when we went into COVID, we were due for a correction. The market typically corrects every 12 to 14 to 18 years on average. And that's a big gap. I mean, that's a 6-year window, right? But historically, that's about when the market corrects, and we were due for that. And when COVID hit, boom, we're like, this is it. Finally, we needed a correction, right? Thought the like everything's on lockdown. There's plastic everywhere, masks, blue tapes, arrows, people telling you which direction you got to walk. Who the hell knew what was going on in our world, right? But like us as real estate investors and entrepreneurs, we're like, this is it, man. Bottom's falling out. Like we're back. We're back to '08, you know? And the world was shut down. The real estate world was shut down for 30 days, 60 days, something like that. And I mean, we're gearing up. Like I had a couple of buddies that went out and put funds together, started to put funds together. And when I say funds, like an institutional um, fund registered with the SEC. They were going to do a big raise and get ready to go out like gangbusters and buy. And I was in the same boat. I'm like, man, I'm talking to some of my investors, some of my partners. It's like, you guys ready to go? Like, this is it. This has got to be it. But then, little did we know, once that faucet was turned back on and real estate was opened back up, it went the complete opposite direction. It went crazy, right? It went through the roof. Absolutely insane. It was nuts. And so you want to ask me to predict and like, fortunately, it was, I we were making assumptions and speculations, but I wasn't putting any dollars at risk. We were gearing up to do some big things should the opportunity present itself, but we didn't put any dollars at risk during that period. So that's very important to know and understand. But you asked me to predict the market. Everything said that was going to be it. The time since the last correction, the major change in the world and in finances, in everything. Like everything said that was going to be the next blowout. Bottoms out, let's go. Like, let's go up, gear up, let's go buy a couple hundred houses. Let's go. But we were wrong. We were all wrong. I mean, it went through the roof. It went the other way. And did opportunities present itself for us? Yes, absolutely, absolutely. There were some opportunities. We did well. Our investors did very well. Our investment partners did very well through that cycle. But it's important to understand that every 12 for the market cycles. So like if you look at a graph, and I'm talking, let's talk PA, Pennsylvania, Pittsburgh specific, right? So when it comes to the real estate market in Pittsburgh, we don't have crazy highs, so we don't have crazy lows. We have some periods where it's normal market. We have some periods it's a little bit better. We have some periods where it's not quite as good, but we don't have the crazy highs. We don't have the crazy lows like parts of Arizona, Phoenix. It's like their market's like a roller coaster. And I have friends and mentors and associates that do very well in those markets because they invest for the long term. They don't get in there and try to time the market and do those predictions. They invest for the long term, and they have a model that works. And regardless of market cycles, market conditions, there's opportunities to be had. So but when it comes to Pittsburgh, we don't have the crazy highs, we don't have the crazy lows, but we have slight fluctuations. But you asked me to predict the market, got me, man. My opinion is that we're not going to see, of course I was wrong, coming out of COVID, but nothing tells us that, we're going to see, a crazy low in the market anytime soon. But if you look at, if you look at market cycles historically, the trends and the graphs, in Pittsburgh, well, this is, more or less nationwide, but the next high is always higher than the previous high, and the next low is typically not as bad as the previous low. So markets, if you look at a graph, historically, markets trend upwards. Upwards. There's ups, there's downs, but if you look at the the starting point where you're at today, historically, it trends up. So what does that mean? What does that mean? Like we have highs, we have lows, but it trends up. What that means is that invest for the long term. If you're investing for the long term, if you're investing on with today's numbers in mind, if you're buying properties that make sense based on today's numbers, not buying on speculation, buy based on what makes sense for today's cash flow and make sure your ratios work, that over the long, and you're investing for the long term, that you're going to make some money, right? Like, you're buying at X today. There's a correction, there's a dip in the market, whatever. 6 months from now, a year from now, 2 years from now, the market has a dip, but you're still cash flowing. The cash flow isn't affected, but the value of the property may fluctuate. But if you look at historically, 5 years from now, 10 years from now, 15 years from now, that property will be worth more than what you paid for it today. For the most part, there could be a period where there's a slight correction where it's equal, or the value may fluctuate slightly, especially if you're in Pittsburgh. We don't have crazy highs, we don't have crazy lows, but the market trends upwards. So what I can tell you is that, I've been in this business for 20 plus years, and the properties that I bought early on, 15, 20 years ago, they are worth a lot more now than when I bought them. The properties that I bought, let's go back 6, 8, 10 years ago. We're in 24 right now. So if you go back, we were buying pretty heavy in 17 and 18. The properties that we bought in 2017 and 18, they are worth more now than what we bought them for in 18. Markets trend upwards. So if you buy, if you invest, I'm gonna end with this, and I'm gonna leave it at that. So the last three things the last of the 3 points that I want to make is, and this is probably the most important, never buy heavy on speculation. And when I say never buy with the emphasis heavy on speculation, is we, our primary business is we create and manage portfolios of single family homes for long-term cash flow. Every home that we buy in our portfolio makes sense the day we buy it. We know what the rents are going to be. It's not a prediction. It's not an assumption. There's compare apples to apples comparison. We own other homes in the area. We probably, we might already own a couple of homes in that neighborhood that are the exact same. We know what that house is going to rent for. We know what it's going to lease for. It's not a prediction when you're buying a cash flow house. Like, you just know. Could it fluctuate $50 or $100 a month? Yeah, it could. But if that $50 or that $100 is enough to kill your deal, you're not buying it where you need to buy. So we never buy heavy on speculation. The bulk of our business is for the long-term cash flow. If you like to do the flips, do the renovations, it's okay. It's okay to do those projects. I'm not saying they don't make sense. I've made a lot of money on flips and infill new construction projects and stuff over the years. I choose not to do those anymore because our focus is the long term, the cash flow, and we've built up a pretty good business there to where the flips just aren't exciting anymore. To me, it's just too much work to do those projects. So I would rather go out and buy 2, 3, 4 houses for the long-term cash flow as opposed to doing 1 or 2 flips. That's my personal opinion. But is it okay to mix those in with your investment strategy and your portfolio? Yes, absolutely. People do it all the time. Makes sense a lot. But you gotta make sure that you're keeping low leverage on those properties. You got lots of contingencies. If you're planning for the project to take 6 months, you better make sure it still makes sense if you sit on it for a year. The best flips and those types of projects, in my opinion, are the less expensive ones, while they're not as exciting, but if you can have multiple exit strategies where, if you buy it, fix it, and try to sell it, it doesn't sell, but it would still make sense from a cash flow standpoint. Those are the best projects for me, because at the end of the day, or those are the best projects in my opinion, because at the end of the day, you buy a house, you fix it up, and you try to sell it, it doesn't sell. Well, there you go. You got a fully remodeled turnkey rental. That cash flows. So if you're getting into the higher price properties, like I was doing at one point, the luxury Pittsburgh market with infill new construction and super high end and flips, you just got to watch. And this is where I say never buy heavy based on speculation. If that's your business model and that's all you do is the high end flips, the high end builds, all that can go away super, super quick. So that's why it's very, very important to have cash flow, to have other means of income that aren't subject to market cycles, market conditions. It's totally okay if you want to diversify and invest in different things. If you want to do some flips, if you want to do some builds, just I highly, highly recommend don't get too heavy in that, because you never know when you're going to get caught holding the bag. So that's it. I'm going to end for today. That's my take on market predictions and market cycles. I thank you so much for tuning in. Thank you for listening. And again, I'm not asking for anything in return here, other than if you like this, if you like what I had to say, if you like this podcast, just share it for me. Share it on social, send it to a friend, copy the link. It's on Spotify, it's on YouTube, a couple other platforms. So super simple to just share it, and then engage with me too. Drop me a comment, drop me a DM. Let me know, what you want me to cover. I'm still working on setting up the studio here in the other room, but I'm going to start lining up some guests here real soon, and we're going to get some different takes and different perspectives on investing in many different things. In our business, in our finances, in our communities, in our health. I got a lot of different good things lined up here coming at you real soon. So stay tuned for that. Thank you so much, and have a great day.